Welcome to the GCV Weekly Briefing podcast, where we break down the key financial and economic developments shaping the landscape for investors, businesses, and policymakers. I'm Matthew, and this week we'll be looking at four major stories. From rising unemployment fueling talk of an interest rate cut, to record investor withdrawals, soaring AI valuations in private markets, and a surprise in UK house prices. The latest data from the Office of National Statistics shows that UK unemployment has climbed to 5% in the 3 months to September. That's the highest level since early 2021 and slightly above the 4.9% that analysts had expected ahead of the budget. The ONS said figures point to a weakening labour market, which is consistent with that of what many employers have been feeling on the ground. Interestingly, for vacancies, they rose slightly to 723,000, but they're still well below the post-pandemic peak of 1.3 million. The number of people on company payrolls also fell by 180,000 in the year to October. That's a drop of 0.6% larger than most economists had predicted. As Richard Carter from Quilter Cheviot explained, many firms have shelved any major hiring plans ahead of the budget, choosing to hold steady until there's a bit more clarity. Wage growth is also cooling now. Average earnings rose to 4.6% in the third quarter, slightly down from 4.7%. Pay sector growth has gone faster, at 6.6%, compared to 4.2% in the private sector. This is also consistent in jobs growth as well. People in the private sector have been getting employed, whereas in the public sector, that's the wrong way around. According to KPMG's chief economist, Yael Selfin, moderating wage pressures and softening the labour market are expected to bring wage growth closer to levels consistent with the inflation target by the end of the year. For the Bank of England, that cooling trend could be exactly what it's been waiting for. Weaker data has strengthened expectations that the bank may start cutting rates as early as December. As Selfin put it, today's data strengthens the Bank of England's case to resume cutting rates next month. The uncertainty isn't limited to the jobs market. Investors have been pulling out money from equity funds at a record pace as nerves build. Between July and October, a massive £7.3 billion was withdrawn from equity funds, the largest outflow ever recorded by Calastone. £3.6 billion of that came in October alone, marking 5 consecutive months of outflows. UK-focused funds saw the biggest hit, losing $1.2 billion, while global and North American funds weren't far behind. Edward Glynn from Calastone summed it up pretty neatly. Investor behaviour is being driven by two main factors: nervousness over high stock valuations, especially in US tech, and fears about potential rises under the nervousness of high stock valuations, especially in US tech, and fears about potential tax rises under Rachel Reeves. He said, for some, it's a simple matter of crystallising capital gains in case the rates go up. For some, it's about protecting their pensions. That sentiment has only grown after a dramatic sell-off in global tech stocks. AI-related companies just lost over $750 billion in market value last week, including a $350 billion drop of Nvidia's share price and $68 billion off Meta. The IMF has warned that this concentration risk, where a few trillion-dollar firms dominate market performance, is now higher than during the dot-com bubble. It cautioned that if these mega cap stocks fail to deliver their expected returns, valuations could collapse as a result, making the broader benchmark index vulnerable to downturns. It's a clear reminder that even the most dominant companies aren't immune to correction risk, especially when sentiment shifts. Whilst public markets are flashing warning signs, the private tech sector is showing a different but parallel story. PwC's latest report shows that the top 100 unicorns, that's privately held startups valued over $1 billion, have seen their combined value rise 44% in the past year, reaching almost $3 trillion. For the first time, AI has taken over fintech as the dominant sector, now accounting for 43% of total unicorn value and around 80% of the total gains. PwC found that 43 of these unicorns raised new funding rounds this year, and 39 achieved higher valuations. AI companies alone more than doubled in value to $1.25 trillion, with 8 new entrants joining the list. Kat Kratstrov from PwC said the availability of private capital and strong investor interest have provided a solid foundation for the growth of the world's most valuable unicorns. Her colleague, Michael Whitten, added that this strength should provide a platform for more broad-based growth in funding and deal activity across the next 12 months ahead. But there's still a sense of caution underneath this optimism. Some investors are questioning how sustainable the AI boom really is, much like the previous story. For our UK propositions, there's also concern around the government's tax approach. Founders from Revolut, Oak North, Quantexa, and ClearScore have warned that their higher capital gains taxes or exit taxes could push tech listings overseas. One letter to Rachel Reeves said that such policies would make the UK less competitive at precisely the moment where it needs to lead. Now, moving on to the housing market, which surprisingly is showing signs of strength despite everything else going on. According to Halifax, UK house prices rose 0.6% in October, the fastest pace since January, pushing the average home to a record £299,000. Annual growth reached 1.9%, a strong rebound from September's slight decline. Mortgage approvals also climbed to their highest level this year, showing that buyer demand has actually remained resilient, even as affordability remains stretched. With average mortgage rates hovering around that 4% mark, many buyers are adapting by extending loan terms or opting for smaller deposits. Halifax Amanda Bryden said that while there is some volatility, the market has proven resilient over recent months. Still, uncertainty around the budget has led to some buyers pausing. Reports that the Chancellor might replace stamp duty with a new levy on homes worth over $500,000 have added to that caution. Matthew Thompson at Cheristons noted that October's property market was noticeably calmer as many buyers have paused to see what the budget might bring. Once that uncertainty clears, however, many expect demand to pick right up again. Bryden added that with house prices rising more slowly than incomes for almost 3 years now, we expect the trend of gradually improving affordability to continue. And if the Bank of England does move forwards with that rate cut next month, it could add more momentum heading into next year. Still, not every part of the housing sector is performing strongly. Shares in Rightmove fell as much as 25% last week after the company warned of slowing profit growth. The firm said its AI investments will help lead to higher profit growth in the long term, a line that neatly ties together with the theme running through this week's stories: optimism around AI, tempered by growth of sense of caution. A line that ties neatly together with the theme running through this week's stories: optimism around AI, tempered by a growing sense of caution. So, to sum this week up, we're seeing a softening labour market, investors growing cautious ahead of the budget, private markets still chasing AI growth, and a housing market that refuses to slow down. Taken together, these stories paint a picture of an economy in transition, where optimism does exist, but confidence is very much fragile. Much depends, of course, on what happens at the next Bank of England meeting and how the budget shapes policy direction heading into 2026. That's all for today's update. Thank you for listening.